This wasn't a robbery. There were no masks, no break-ins, no illegal transactions. What happened in 2008 was a scam, but it worked because it was completely legal. Banks sold products they knew would fail. Rating agencies approved them. Regulators watched it happen. And when the system collapsed, ordinary people paid the price. This is the story of the scam that only worked because it followed the rules. In the early 2000s, home ownership was sold as a guarantee. If you owned a house, you were told you were safe. Property values always went up. Housing was stable. Housing was secure. Banks leaned into that belief. They began offering mortgages to people who had never qualified before. Low incomes, unstable jobs, little to no savings. These were called subprime mortgages. At first they looked harmless, low introductory interest rates, minimal paperwork, approval in days, sometimes hours. The message was simple: buy now, worry later. But the mortgage itself wasn't the real product. The real product was what happened after the loan was issued. Banks bundled thousands of mortgages together and sold them as financial instruments. These bundles were sliced, repackaged, and resold, often multiple times. Risk wasn't eliminated. It was distributed so widely that no one could see it clearly anymore. If a borrower defaulted, it didn't matter. The bank had already sold the loan. Profit was made up front. Consequences came later, to someone else. Nothing about this was illegal. Banks weren't required to ensure borrowers could repay long term. They only had to disclose the risks. Buried in paperwork few people understood. Rating agencies were paid by the same banks whose products they rated. That conflict of interest was legal. Regulators believed markets would correct themselves. Intervention was seen as unnecessary, even harmful. Every incentive rewarded volume, speed, and short-term profit. No one was paid to slow down. No one was paid to ask hard questions. Legally, the system was working exactly as designed. Some people did see it coming. Economists warned that housing prices were inflated. Insiders privately described the products as toxic. Internal emails revealed doubts about sustainability, but warnings without authority don't stop systems. As long as disclosures were signed and regulations technically followed, nothing forced anyone to stop. Complexity protected everyone involved. When risk is too complicated to explain, it becomes easy to ignore. When interest rates rose, borrowers began to default, not gradually, all at once. The bundled products collapsed together. Institutions that believed they were diversified discovered they weren't. Banks failed. Credit froze. Global markets panicked. Millions lost their homes. Pensions evaporated. Entire economies entered recession. The damage wasn't confined to Wall Street. It reached living rooms, savings accounts, and retirement plans. This wasn't an accident. It was the predictable result of incentives working exactly as intended. For ordinary people, the crash wasn't abstract. It meant foreclosure notices, lost jobs, savings wiped out overnight. In the United States alone, millions lost their homes. In Europe, governments imposed years of austerity. Trust was shattered, not just in banks, but in institutions meant to protect stability. People assumed someone would be held accountable. Very few were. Many expected arrests. Instead, they got fines. The reason is simple. The system wasn't built to assign blame. It was built to diffuse it. Decisions were spread across departments, firms, and legal entities. Each action taken alone was legal. Responsibility existed, but it was fragmented. When responsibility is everywhere, it effectively exists nowhere. Executives kept bonuses. Banks paid settlements without admitting wrongdoing. The public absorbed the losses. New regulations were introduced. Capital requirements increased. Oversight improved, on paper. But the core structure remained. Complex products still exist. Conflicts of interest still exist. Incentives still reward short-term gain. The scam didn't disappear. It evolved. The most dangerous scams don't break the law. They use it. They rely on complexity, distance, and plausible deniability. They thrive when legality is mistaken for safety and compliance is mistaken for ethics. This wasn't a failure of morality. It was a failure of design. The 2008 financial crisis wasn't caused by criminals hiding in the shadows. It was caused by systems hiding in plain sight. A scam built on incentives, legality, and silence. And that's what made it work. This was the scam that only worked because it was legal.